Okay, let's dive right into this. Welcome to The Explainer. Today, we're unpacking a massive, literally brain-breaking contradiction in personal finance that challenges everything we think we know about building wealth. It's the classic battle, stocks versus real estate. And the data we're about to look at reveals something your realtor and your stockbroker probably want to hide from you.
Let's start with the hard math. Over the last 100 years, the S&P 500 has returned about 10.4% per year on average. Adjusted for inflation, that's roughly a 7.3% real return. Meanwhile, U.S. home prices, measured by the Case-Shiller Index, well, they returned less than 1% annually in real terms over that exact same century. To put that into perspective, if you parked $100,000 in the S&P 500 for 30 years at that historical average, you're walking away with about $1.74 million. That exact same 100 grand parked in raw home appreciation, just $324,000. So mathematically, stocks don't just beat housing, they lap it 5.4 times.
But here's where it gets totally wild. Because despite stocks being the mathematically superior asset by an absolute landslide, the reality of human wealth tells the exact opposite story. According to 2022 Federal Reserve data, the median homeowner has a net worth of $396,000, and the median renter just $10,400. Homeowners somehow end up with 38 times more net worth than renters. 5 times worse asset, 38 times richer owners. I mean, that math just shouldn't work, right? But it does. So how on earth is this happening?
Well, that brings us to Section 1, the real estate cheat code.
To solve this mystery, we really have to uncover why real estate actually builds wealth in the real world. And there's a secret mechanism at play here, the sheer power of leverage. See, when you buy a stock, you're using your own money. When you buy a house, you put up a fraction of the cost and the bank supplies the rest. Let's just walk through it. Say you put $80,000 down on a $400,000 house. If that house goes up just 3% in a year, that's $12,000 of appreciation. But because you only put in $80K of your own cash, that 12 grand actually represents a 15% return on your money. Add in the roughly $3,600 in principal you pay down on the mortgage in year one, and suddenly you're looking at a massive 17.6% return on a house that barely beat inflation. That right there is the cheat code.
But, leverage is a switch, and it can definitely flip the wrong way, creating a pretty dark trap. Take the 2008 crash. The S&P 500 dropped a brutal 56.8%, but it recovered fully by March 2013, just 5.5 years later. Housing, on the other hand, the national index fell 27.4%, but in real terms, adjusted for inflation, housing didn't hit a new high until May of 2022. That is 16 years to recover. In markets like Las Vegas or Miami, prices plummeted around 50%. If you used leverage and put $80,000 down on a $400,000 house that dropped 20%, your equity was totally wiped out. You owed $320,000 on a house worth $220,000. You were literally trapped. Stocks might make you panic when they crash, but they don't hold you prisoner.
Which leads us perfectly into Section 2, housing's hidden friction.
Beyond the risk of a crash, there's this invisible drip of homeownership costs that, honestly, most people completely ignore. Owning a house is basically a subscription to a building that randomly tries to kill you with plumbing. Let's tally up these friction costs over a typical 7-year hold. First off, property taxes average 1.1% nationally per year, which is essentially rent you pay the government forever. Maintenance usually follows the 1% rule, meaning you're dropping about $4,000 a year on a $400,000 home just to keep it standing. Then there's insurance, averaging $2,500 a year nationally, but soaring up to $8,500 in places like Florida. And don't forget that sudden $17,000 check for a new roof, plus the 5.7% realtor fee when you finally decide to sell. Add it all up, and you are losing 10 to 15% of your home's value in pure friction costs before appreciating a single dollar. Real estate doesn't have a cheap expense ratio, it has a whole tax bracket.
Because of this, our perception is totally skewed. Economist Robert Shiller ran the numbers, and the results are honestly stunning. Homeowners estimate their historical real return at about 7% per year. The actual real return, just 0.4%. People overestimate their gains by 17 times. Why? Well, human psychology is a bit flawed. We vividly remember the closing day sticker price, but we conveniently forget the $200,000 we shoveled into the foundation over the years, the property taxes, the insurance premiums, and all those weekends completely lost at Home Depot. The sticker price is super dramatic, but that friction drip, it's completely invisible.
All right, Section 3, the problem with stocks.
So if housing has all this invisible friction, why aren't more people getting filthy rich in stocks? After all, Vanguard ETFs cost almost nothing. We're talking like $3 on every $10,000. There are no property taxes, no leaking dishwashers. Well, the truth kind of hurts here. You are the problem with stocks. The asset is perfectly fine. Research from a firm called Dalbar tracks investor behavior, and they consistently find that the average stock investor underperforms the S&P 500 by 3 to 5 percentage points every single year. It's not because the market is rigged against you. It's because normal people constantly check their accounts, panic sell the second the market drops, and emotionally try to time the market, usually buying back in only when things feel safe, which happens to be exactly when prices are sky high again.
And this is exactly where real estate wins. It imposes forced discipline. Think about it. You cannot panic sell your house on a random Tuesday morning from your phone. It takes 60 days, you have to pay a massive 6% realtor fee, and you literally have to pack up your entire family and find somewhere else to sleep. That massive friction inherently prevents you from self-destructing. The very same friction that makes real estate incredibly annoying is the exact mechanism that saves you from your own brain. It turns a house into a forced savings account with extra steps. You put money in every single month, and you just can't easily take it out.
Now, real estate absolutely does flex some serious tax muscle. Things like the $250,000 or $500,000 capital gains exclusion, building depreciation, and 1031 exchanges to defer taxes indefinitely. But here's the catch. Most of those loopholes only really matter if you're already wealthy. For everyday people, there is a much, much better tax shelter sitting right in front of you. The 401k employer match. I mean, it's an instant 50 to 100% return on your money before the market even does anything.
And while we're busting myths, we really need to talk about that idea heavily promoted by all those online gurus regarding rental properties. You know, the old 1% rule where monthly rent equals 1% of the purchase price. Yeah, that is largely dead. With a modern median home price of $480,000 and median rent sitting around $2,000, the math is just completely broken. If you were to buy a $400,000 rental today with 20% down at a 7% investor rate, after you factor in taxes, insurance, maintenance, and management, you aren't making passive income. You're actively losing roughly $11,500 a year straight out of your own pocket. Mortgage rates are simply higher than rental yields in almost every major U.S. market right now.
All right, let's move to Section 4, the real wealth formula. So what actually works for regular people? Let's look at the ultimate framework drawn from a study of 10,000 actual millionaires. Imagine a 30-year showdown between 3 friends, all starting at age 32 with 80 grand. Friend 1 puts it all in index funds, decides to rent, and maxes out his 401k. At age 62, boom, he has a net worth of $2.1 million. Friend 2 uses his 80k as a down payment on a house, pays off the mortgage over time, and steadily funds his 401k. At 62, his net worth is a solid $1.6 million. Both of these disciplined friends totally won. They made different choices, sure, but they stuck with them. But then we have friend 3. He tried to time the market, panic sold in 2008, bought a house at the absolute peak, sold it at a loss, and then tried his hand at cash negative rentals. At 62, he's sitting on just $180,000. Ouch.
The data shows us exactly what the typical self-made millionaire actually does. And here is the middle-class wealth formula. First, buy a modest primary residence, ideally costing 1.49 times your annual income or less. Second, max out your 401k to the employer match. Third, fill a Roth IRA. And finally, just dump whatever is left into a low-cost index fund. Honestly, it is boring, it is repetitive, it is slow, and it is incredibly effective. It's the exact reason why everyday teachers are statistically more likely to become millionaires than high-earning lawyers. They just keep compounding quietly for decades.
So it really all comes down to this one idea. Stocks will compound your money faster mathematically. Real estate will compound your discipline harder behaviorally. The first one rewards your brain with superior numbers. The second one physically protects you from your own emotional mistakes. The richest version of yourself isn't necessarily the one who picked the mathematically perfect asset. It's the one who matched the asset to their personal psychology. Honestly, if you know you're going to panic sell, get the house. If you hate spending your weekends fixing roofs, buy the index funds.
Which leads us to the only question that actually matters. Stop arguing about stocks versus real estate on the internet. The real question you need to ask yourself is, will you stay in the game for 30 years? Because regardless of the vehicle you choose, wealth isn't built in a day, and it is certainly not built by jumping ship every time the wind changes. It's built by finding a strategy you can stick with for 3 whole decades. Thanks for joining me on this explainer. I really hope this helps you reevaluate your own long-term strategy. Keep learning, keep compounding, and I'll catch you next time.